Well, welcome everyone to Steve Savant's Money, the name of the game. I'm your host, Steve Savant, syndicated financial columnist and money color commentator. On today's show, the current mortgage environment. Part 2 of our series on your home mortgage is your number one IOU with nationally recognized mortgage expert and author, Steve Walsh. Welcome to the second segment, Steve.
Glad to be here, Steve.
Well, if you missed our first segment, you need to go out and watch, especially that end part of our segment. We really got into some really juicy stuff. We're talking now about the current. The first segment was kind of the way it was, and those days aren't coming back anytime soon. Yes. But let's talk about the current now. People now can't just do what they want. We said in the first segment, no money down, low FICO score, interest only, 3, 4, 3, 5, 7 arms, 40-year mortgages. All that stuff is pretty much gone.
Yeah, it's pretty boring. Yeah, maybe I should have gone into car sales or gone auto financing. But now it's pretty straightforward. You have to have your ducks in a row. You have to have a job. You have to have down payment and
good credit.
Yeah, good credit. That's it. So if you have those three things, you know, you can buy a house. Congratulations.
All right, I want to talk about something because this is all over the web. There's a debate in my field, financial advisors, insurance professionals, fiduciaries, whether they're CPAs or tax attorneys. Everybody's always looking between the issue of here's a 15-year mortgage, here's a 30-year mortgage. What right now, is the spread that different, and is it worth paying your mortgage down using a 15-year amortization schedule?
Again, rules of thumb come in here, and I've always thought if the bank's going to take that extra money from me, if they're going to take an extra $300-400 out of my pocket, what are they going to give me in return? If they're going to give me an eighth of a point or a quarter point, forget about it. I'll take my money, and then I can still choose to overpay my mortgage. You know, paying an extra $100 a month, $200 a month can take 7-8 years off back into your mortgage. So you can achieve it without being forced into it. And one of the lessons of 2008, when the property values declined, we put a lot of borrowers who wanted that low rate, right? They wanted the 15-year rate. At that time, it was about a point lower. And what happened? So they went to these lower rates, this big payment. Then they called me up saying, I got to get out of this. You know, I've lost overtime at my job. My wife lost her job, whatever. The economy went south. And so we got phone calls. People wanted out of them. Guess what? You can't get out of it because your house has gone down in value. We can't redo the loan. And so they were stuck in these higher payments. And I realized at that point that flexibility is important. And I guess we undervalued flexibility going into this. And so looking back, I said, are you sure you can afford this payment? Your wife, you lose your overtime at work. Can you afford this payment? And if they're comfortable and they have plenty of assets built up and they have a real nice portfolio, sure, go into a 15-year fixed and you probably save just under a point, 3/4 of a point. It's not a bad trade-off. And especially if a borrower has a history of overpaying their mortgage. You know, a lot of people overpay their mortgage, I have for 10 years, for 5 years, however long. Then go to a 20 or a 15. You know, a 20 gets you a little bit better, a 15 gets you quite a bit better rate. So it's not a bad way to go. Otherwise,
but it sounds like good people. Listen, I'm doing the good thing. I'm paying my mortgage off earlier. Oh, I'm paying I'm a whole point less. It sounds it's so good. It sounds like I can understand why people that overextended themselves got in trouble back in 2008. But now we're talking about people that are good people, have jobs, and they're doing proper management, and they even got hurt of this.
Everybody. It took out a lot of people, and so just be sure you're comfortable with that payment.
All right, so you're recommending instead of doing the 15 to save a point, it's no point spread now, is it?
No,
between the 30 and the 15,
because we have with the Fed raising rates. They're actually bringing we're seeing kind of what's called a flat yield curve. So whether you borrow for 2, 5, 7 years, it's almost the same rate. So yeah, we're seeing the spread narrow.
You can always pay more on a 30.
Yes.
If you can still shorten it by 7 or 8 years. And if you get in trouble, then you don't have to make any payment.
Call it a minimum payment. People say my mortgage payment is. No, your minimum payment is. Throw an extra $100, $200. You get a Christmas bonus. You want to throw an extra $5,000. It's amazing what it does down the road, right? So
well, let's talk about today's down payment. What kind of checks are we writing now? I mean, I'm not talking about the more special FHA first-time buyer, although maybe we should talk about it. But what about the normal person?
They're coming out with 1% and 3% down. Those
again.
kind of the FHA is trying to be creative, but it's not so simple. Here's the hard part: is that not everyone qualifies for it. every time we get a borrower call us and say, hey, I want this 1% down. Well, you make too much income. It's got income restrictions on it or geographic restrictions. That side of the road, I actually had this recently. A borrower was buying a house on one side of the road. He qualified for a no money down loan. But if he bought on the other side of the road, he liked the house across the street better. It didn't qualify for a no money down loan. So it has geographical restrictions, income restrictions. So it's not so clear cut. In the old days, the old days, we used to be able to say no money down, 5% down, you could get a house. Now, you really got to take the whole file and look at it. And that's why, realtors, and before somebody goes out and starts getting excited about a house, they need to contact somebody, a broker or a bank, and get an idea what this new environment is. Because, we talk to people who, I bought, 10 homes in my life, over my lifetime, and they're seeing something a lot different now. They're like, what do you need that for? What do you need that for? There's a lot of documentation involved. So you really have to have your ducks in a row. So you need to talk to somebody, see what you can afford.
So these underwriters that are writing these mortgages, there's the due diligence is online now. We're looking at a disciplined way of looking at mortgages.
It's called zero tolerance lending.
Oh, wow.
So if an underwriter signs off on something, they may be packing their bags.
Wow.
The banks do not want to buy back mortgages, and Fannie and Freddie are excited to throw them back at the banks. So it's kind of a scary situation.
What about the normal people that aren't doing
What
FHA or they're the first time buyer? Do you have to come up with what, 10 down, 15,
5-10% down? Yeah.
Okay, still not that bad though. Really, when you're thinking about it, 5-10% down is not that bad.
And there's nothing wrong with if you're buying a house, you should be able to save 5%, shouldn't you? You beg, borrow, steal. You call your parents, a rich uncle, get that 5%, put it down in the house. I don't believe that to be unreasonable.
We were talking earlier about, hey, I don't know about doing a 15 because I might get tight economy. My bonus may not come through. Maybe I'll lose my job. So I'll put extra when I have it. And if I don't, I don't.
Perfect.
However, I'm looking at this other one. People pay, well, what's with people paying twice a month? Is that worth anything? Does that do anything for you? I'm not paying once a month. I'm paying twice a month.
It's funny. Whenever mortgage rates would go up and the volume would slow down, all the banks would approach us with, hey, we'll pay you a couple $100 if you put people into these biweekly payments. It was a little incentive, right? So we really looked at them, and you can achieve the same thing on your own. You just take what your mortgage payment is, divide it by 12, and each month add that to your payment. And with auto withdrawals, everyone sets their everything on auto pay. Just set it up on auto pay for an extra $100, $150 a month, whatever. Again, 1/12 of your payment is, and you've achieved the same thing. You'll say take 6-7 years off your mortgage. So you don't necessarily have to go into this biweekly program.
Okay, now we're looking at Fed rates. So we just had a rate change. We're recording right now in the month of March. We had a upswing. What are you looking at now? What is the conventional 30-year? What is that about today?
Low to mid 4s.
Okay.
But here's one of the big changes. When you see a rate quote in the newspaper or online, we got all excited. We see, hey, 3.9 or 4.25. There's a big asterisk beside it now, partially because of the Consumer Financial Protection Bureau, but there's a big asterisk because if your credit score, say, is 679, you're getting the hammer. We're talking they add 4 or 5 points to the rate. So somebody with good credit is looking at 4.25. If they're under 679 because they had some miscellaneous medical bill they never knew about and they didn't pay, their credit scores dropped, they're going to be at 5.25. That's the difference. So there's a big difference between a 679 credit score and a 750 or 760 credit score.
Tied to the interest rate that they're going to pay.
Absolutely. So they've made some big changes there. It used to be just an eighth or a quarter point difference, right? A little touch. Now it's a completely different loan when you look at it. So
okay, so really now it's not only
credit score
makes a difference.
It's make or break on a lot of deals.
So I used to see the management. I saw Susie Gorman on with television one time, and he was talking about FICO score, how they build it, how they use it for the consumer. And at first I thought it was like, who cares? But now I see that now, especially what we're doing now, this really matters to keep your score up. And if you got little ancillary problems like this unpaid bill, you need to take care of it.
Oh, we see it every day. People, unbeknownst to them, had a $20 collection, and it drops them into the 600s, and it's like, these are now the loans.
Is it better to square it off or better to just say, I don't know what they're talking about?
Try and get it paid and deleted because it really does have an impact on your loan. But there's a new thing. As of December 10th last year, the repositories came up with something new. So we don't just have a credit score anymore. They added trending data. And this is supposed to be the biggest thing since credit scores. So when you get a credit score now, it'll say 700. And then right below it, it'll say this credit score is likely to go up or down over the next 30
Well,
to
you're on
60
the watch
days.
list, so one way or the other.
Yeah, they're like, this guy's going up or down. And Fannie Mae is starting to incorporate that into their approval algorithm, that word algorithm. So everyone's starting to look at trending data. It's going to be big. They're telling us it's going to be big.
Wow.
So,
well, don't forget to watch our next segment, the Dodd Frank Impact. Part 3 of our series on your home mortgage is your #1 IOU. And keep in mind, before moving forward with any of the ideas on the show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.